are with Barclays Capital Commodities analyst Amrita Sen. Amrita, thank you much for joining us today. We can see the price of oil is down 14% this year. Is that decline all due to the global slowdown?
Well, partly yes, because the fundamentals in the oil market have actually been very strong. Despite the news that you hear about the macroeconomic pessimism that's centered very much in the US, if you look at US oil demand data, it has surprised to the upside every single month so far this year. And I think one of the key things in the oil market now is that though the US remains the largest oil consumer in the world, the consumption growth is actually coming from the Far East. That's China, India, and the Middle East. And that has what has actually led to such a strong recovery in global oil demand. However, contrary to that, macroeconomic pessimism has weakened considerably, and that's what's really weighing on oil prices.
Given the level of macroeconomic pessimism, is the price of oil currently overvalued?
I would say absolutely not. If anything, it's purely due to the macroeconomic pessimism that prices are kind of languishing at the very bottom of the range, which is 70, 75. That's the rock bottom I'd say prices should go to, given that there is a view in the market that sub-70 investment in the oil industry, it's not going to be sustainable. And OPEC have definitely made a very strong commitment at keeping prices at $70. If anything, given the fundamentals of the oil market, prices should be well above $80, I'd say, at this point in time.
Is it likely, with the price as it is at the moment, that OPEC will announce another production quota rollover when it meets on the 14th of October?
Yeah, I think in terms of OPEC policy, there's very little they need to do to change the dynamics. They've achieved pretty much what they've set out to achieve. Production has stabilized this year, and prices have kind of been in the range that they're most comfortable with. So not much of a change in OPEC policy.
So now, how would you describe the attitude of hedge fund managers to oil as an asset class at the moment?
I think hedge funds are very cautious. You've seen that in the CFTC data. The net length has come off significantly over the past 3 or 4 weeks. And I think in general, given the macroeconomic pessimism that is still there, despite some very strong numbers coming out on the oil market, both demand and supply side, they are remaining very cautious. Very little new length is being established, and it's much more a wait and watch policy that they are sticking to.
So what about the future direction of the oil price then? I know that's asking you to look into your crystal ball, but where do you see it going?
Again, taking aside the macroeconomic pessimism, prices should be rising steadily from here on. Again, given OPEC's spare capacity, you should not see a huge rally in prices above $100 at this stage. They have enough production capacity to bring on to the market should prices rally. So a modest rally upwards towards the 80s and the $90. However, given the macroeconomic concerns that are still persisting, that profile or that trajectory is likely to be much flatter. So a very modest increase from here on into Q4. So we've got a $78 average for 2010 and moving into 85 for next year. So very slow improving outlook for oil prices. And if the macroeconomic outlook improves, then there is risk to the upside for our price forecast for sure.
Amrita Sen from Barclays Capital, thank you very much indeed for joining us.